Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Ty. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good. Though, like a lot of investors, a little bit unsettled over the market right now. There's some significant volatility that we're seeing here in March of 2020. And that's what we're going to talk about today. We're going to talk about market volatility, what's creating some of this volatility, and what you can do to prepare your portfolio for the near term and long term based on this market volatility. First of all, Ty, just take us through what we're seeing as far as the volatility in the market right now. And also, let's touch on, one of the pressure points that people are seeing, and that is, the S&P went into correction territory just 10 trading days after it hit an all-time high. Mm-hmm. So again, we need to look at this volatility and ask ourselves, okay, are we concerned about a bear market or are we concerned about a correction? So far, all indications show that we're looking at corrections, which is, a double-digit downturn from an all-time high. And that's important to know because typically corrections, return back to normal or into growth mode significantly quicker than bear markets. 2008, 2007, 2009, in that time period, we had a bear market going, not a correction. So let's make sure we understand this. It also looks very, very indicative of what we saw in December of 2018. Significant sell-offs, significant gains thereafter. So we're seeing the sell-off portion. We're seeing the significant volatility. So we're looking at this saying, is this a parallel or not? But we'll talk about those things. But Ty, let's talk a little bit about the volatility we're seeing now.
Yeah, Dean. So right now, as we are in early March of 2020, stock market volatility is really at the forefront. And going into 2020, at the end of 2019, there was certain benchmarks out there like the S&P 500, the Dow, the NASDAQ, all of them did really well. Some were up even almost 30%. So going into 2020, many stock markets have neared all-time highs, and many have more than doubled or even tripled over the last decade. Now, the S&P 500 index, for example, that is a broad index measuring 500 of the largest U.S. companies. It saw its price rise from 700 in March of 2009 to over 3,300 in February of 2020. So going from the end of 2019, January of 2020 was a good month for the stock market, and then into mid-February, and the market hit an all-time high in mid-February. But as we know, markets don't go up forever, and the end of February was a brutal reminder of that for many people. Now, heading into the end of February, as many people know, the coronavirus, which was the zoonotic virus out of China that is starting to spread, that triggered a steep stock market sell-off, and many major indexes fell anywhere between 10 to 15% off their recent all-time highs, leading to a market correction and heading towards bear market territory. Now, when the markets fell 10 to 15%, Dean, as you had mentioned, that happened in only 7 trading days. It went from all-time high to more than 10% down, which is automatically it's called a stock market correction whenever you lose 10% or more. Now, 20% off the high is considered a bear market. So we're not in bear market territory yet, but that was one of the quickest times that we have ever went from all-time high to correction within less than 2 weeks trading days. So luckily, for those people who do have a plan, however, they can feel more comfortable during these times of severe stock market volatility. And that's a reminder that I see oftentimes with clients and just with different people in general is the ones who have a plan, usually they're better prepared to face this volatility as opposed to the ones who don't really have a plan and the ones who make a knee-jerk reaction. So with that said, fear is a natural reaction, and as humans, we're hardwired to react to situations that threaten us. And with the coronavirus, there's really two different types of fear. There's fear of the virus itself that can make people sick, but there's also the market reaction that can cause financial loss. And oftentimes when people have fear, they can react irrationally, and that's something that we want to remind our listeners not to do, just because making a knee-jerk reaction whenever you have any type of major disease or virus like this that hits the stock markets, it usually will never result in anything good over the long term. So that's something, first off, that you don't want to make a knee-jerk reaction. And in addition to the coronavirus, though, that's only one part of the puzzle. The other thing is, with 2020 being an election year, the Democratic primaries, they're all happening. Super Tuesday had just happened. So when you have the rise of Bernie Sanders versus Joe Biden for the Democratic candidate, the market also reacts to that too, just based on different economic policies that they each have. So that's another thing that the market showed, where it's not only reacting to the coronavirus, but politics are also going to play a huge role as well. And we're going to go over what to do based on this market volatility, based on where you're at, as we get into the show here.
Okay, and another thing we're going to throw on top of that, Tyler, is we always look at it from this standpoint, and we ask the investors to look at it from this standpoint, and that is, you need to be short-term aware. In other words, we need to make sure we're aware of what's going on with the scare and the possible slowing of the economy due to the pandemic, the coronavirus. But you also need to be long-term focused, and that is, this too will pass. We don't know. We're not doctors. We don't know how deeply this could affect our economy at this point. But again, if you look at this in terms of parallels to previous pandemics, Tyler and I looked at some of those pandemics, and we saw a significant V-shaped pattern with a sell-off and buy-in. If you look at Ebola, if you look at SARS, if you look at the Zika virus, even though there's some underlying differences, such as how the economy was doing at that particular time, or whether it was a political year or not, they all have one thing in common. That is the pattern of sell-off, which was hard, it was radical, it was deep. However, the upside of the V pattern was also somewhat radical and significant growth. Now, that doesn't mean that tomorrow we're going to see that V pattern start to happen already. It's going to take a little while here until the market decides which way it's going to go. We're taking, 1,000 point swings in 2 and 3 days right now. So again, the market really hasn't stabilized. And for those people who bring in the quote from Warren Buffett, and that is, he's using this as a buying opportunity, that's wonderful, but you have to be sensible too. And that is, when you buy in, we typically go in very small amounts consistently instead of all in at once, because you don't know if you're going to have a double bounce, whether it be positive or negative. So you want to go in smaller amounts. Don't worry so much that the market went down, a point or a point and a half after you went in yesterday, because unfortunately or fortunately, based on the market, it could bounce up a point or a point and a half the following day. That's the kind of market we're in. So what you want to do is utilize positions, take some of your gains that you've made over the last 2 years. Remember, you did make significant gains in your portfolio, or you should have the last couple of years, and there's still a lot of that gain on the table. Another thing before we go on, and that is, just don't get into a habit of looking at the market thinking that's how your portfolio is performing. Because if you have a balanced portfolio, if you're carrying some cash in there, if you're carrying some bonds, if you have a mixture of large cap and some small and mid-size cap investments, chances are you're a little bit more diversified than if you just look at the pure S&P, NASDAQ, and Dow when the news is on. Typically, you're going to see that your portfolio isn't bouncing as much if it's a bit more diversified. So next thing we're going to talk about is, what do we do? What do we do in a situation like this? Tyler, let's start with some of the reactions we have when people see this market hit them.
Yeah, Dean. So now, after talking about the recent market volatility, the next question becomes, okay, well, what do I do then? How do I react based on my portfolio? If I'm not supposed to make a knee-jerk reaction, But yet, if I do want to reposition without making knee-jerk reaction, where we want to be near-term aware but long-term focused, what should I do? And now, what you should do during times of major stock market volatility, obviously it's often going to depend on a number of factors that are going to differ from person to person and situation to situation. And we say that all the time, where no two people have the same financial situation, so none of their strategies are going to be exactly alike. But we're going to take a look at it from two different angles, one being younger investors and one being older investors. And before I get into each of those scenarios, the first thing is, Dean, you talk about this all the time. It's something that we are big believers in, but always by having some sort of cash on the side is how people can actually take advantage of this market volatility. And it's what everyone wants to do, but no one can do unless they have cash in the first place. And that is buy low, sell high. So if you are, even if you're younger, having cash on the side at any time is the perfect time to go and buy during times of this market volatility where the market's going down. Same thing, even if you're retired, where with a lot of our retirees and pre-retirees, we always have a certain portion in cash where we can take advantage of buying opportunities like this. But first off, for those people who are younger investors investing in their 401ks or other retirement accounts, we definitely don't recommend selling off positions or making any knee-jerk reactions within your 401k, but instead use any type of major dip as a great buying opportunity. And that's something that you can do automatically without having to think about it if you dollar cost average. And what that is having a certain amount, and that's what many people do who are currently working, where they have money taken right from their payroll and it goes right to their 401k every single paycheck. So that's something that many people are doing already, as long as they don't stop their contributions or change all their allocations around too much. But people who are young really need to take advantage of their long-term time horizon and view this market volatility from a long-term point of view. If your investments are designed for your long-term retirement objectives and not today's needs, then there's really no reason that you should be selling good investments if they're going down based on the stock market, where instead you should be doing the exact opposite. Instead of selling those investments and shifting to something a lot more conservatively, if you have 20 years left before you need the money, stay put, because if you were in good investments that were growth oriented in 2019, they're still good investments here in 2020. It's just that they're getting hit by the overall market volatility. And what you should do is you should use that to buy more. And by simply putting money in every month, when the market's down, you're actually utilizing it to your advantage and buying more shares at a lower market. Okay,
now I want to throw something else in there too, Tyler. You just got me thinking about this, and that is, for people who are still, 20 years away from retiring or more, this is still a great opportunity for you right now. We have people that have the opportunity to put money into an IRA, and we're hearing some of them, especially some of our younger clients, they're saying, well, should we wait until the market picks up? No, that's absolutely not what you want to do. If you're going to be contributing cash into an IRA right now, you want to buy more shares at a lower price if you're going to be in the workplace and not using this money for some years, because your chances are, there's never a certainty. We know that in the stock market, but your chances are you should probably get more growth out of that. The other thing too is we're telling people, there's a silver lining with Roth conversions right now. It's a great time to start converting some of your IRA money to Roths in preparation for retirement. You want to do it when the market is down, because you're converting more shares at a cheaper price with a better opportunity for growth. So if you're looking at Roth conversions, I would rather do it when the market is down than when the market is up.
Exactly. Good. Very good point there, Dean. And Roth conversions are something that we definitely advocate for many of our clients, especially the younger ones. But yeah, take advantage of it, because you're going to be paying less in taxes as well when the market is down, than opposed to when the market's up, by doing the Roth conversion. So that is a very good point there. The other thing that I want to say, especially if you're a younger investor, is that oftentimes when we have a major disease or virus outbreak, and you can go back 10, 15, 20 years with the SARS and the MERS outbreaks as well, there's a V-shaped curve that oftentimes happens where the market sells off drastically. It is what many people call oversold, where oftentimes it reacts as oversold and then it rebounds back quickly, or does what's referred to as a dead cat bounce, where it bounces right back. So you definitely don't want to make changes at the wrong time by selling off at a low point, and then here it makes that V-shaped curve and rebounds right back up. And in this market today, where it's so volatile, one day the market's up 4%, the next day it's down 3%, and it kind of has continued that pattern, one day up, one day down. The last thing that you want to try and do is time the market, because in this market, you never know. It's not about timing. We say this from time to time, but it's not about timing the market. It's about time in the market. So again, you do want to be short-term aware, but especially if you're younger, you want to be more so long-term focused and actually use this as a buying opportunity as opposed to going and selling off positions because you're scared.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, now we're going to talk about building the portfolio for this volatility if you're a pre-retiree or a retiree. And the reason we look at that is because, again, you've heard us say this in the past, and that is the great phenomena that happens when you become a retiree, and that is no more payroll. So your portfolio really needs to be, it needs to stand on its own 2 feet. It needs to be able to respond to market shock like we're going through right now, and it needs to be built for growth and potential withdrawals that are going to come out in the form of income. So if we look at it, the first thing we're going to talk about is pre-retirees, and that is, okay, as you're going through your 50s, you need to start preparing your portfolio for the next stage of your life. One of the major problems we see people make right now when it comes to volatility in the market is they will go ultra conservative in their portfolio, whether it's a 401k or their IRAs or a brokerage account. And what I mean by that is they will say, well, I'm going to go in there and I'm going to change some of my large cap growth opportunities or large cap value into bond positions or fixed income. Well, that sounds good as far as market loss, but remember, look at the market right now. It's going up one day, down the next, up, down. I mean, it hasn't figured out which way it's going to go. The other thing that we see with that, and I think it's a bit of a mistake, well, both Tyler and I do, is once the market starts heading in the right direction, we start seeing growth coming out of this V pattern after the coronavirus and politics and everything that's going into the sell-off here, is many times they will stay there too long and miss some of the most significant growth opportunities. There's a situation where we know of 2 people who back in December of 2018 sold out their portfolios and did not become fully invested until probably June the following year, and their portfolios are still suffering as a result. So you don't want to become too conservative. Conservative and safe are not the same. Please understand that. Safe is we refer to as a fixed position. Now, conservative is safer than some of the growth opportunities and speculative stocks. But if you get into a conservative situation, conservative typically gives you a lesser rate of return, but it also gives you less of a negative bounce too. So Ty, what else do we talk about when it's pre-retirees and retirees portfolios?
Yeah, so differing from younger investors are pre-retirees and retirees. The coronavirus volatility, it's a reminder of why it's important to stay invested in, or to stay diversified, in the first place, and not try to be too greedy and shift your allocation riskier than you would like to try and pick up more growth potential. So what I mean by that is this whole coronavirus, it came out of nowhere and the market lost over 10 to 15% in 1 week. And you want to be diversified in the first place because that's something that you can't correct when it's already happening. You have to already be diversified. And for many people, I've seen it where it's human nature, again, to get greedy when you see the stock market doing almost 30% in 2019. You want to try and pick up on all that growth. But then, as we mentioned before, the market obviously never goes up it's never going to continue to go up for forever. We're going to have a correction at some point. And this correction that we had came out of nowhere. It hit pretty hard. And for those people that were trying to pick up on that last bit of growth from the end of 2019 into 2020, they got hit very hard as well, and some might have been caught off guard. And that whole reason is because they shifted more aggressively than they were willing to be. And on the downside, it hurt them more than they would have liked. So that's why for pre-retirees and retirees, always important to stay diversified in the first place, not get too greedy, not try and chase market gains. And then also, again, for pre-retirees and retirees, it's very important to have some cash built up, ideally before market volatility like we're seeing right now. So that's something that we do oftentimes where we call it taking gains off the table, giving your portfolio a haircut are a couple terms. But it's basically known as selling high, where when the market's doing really well, when we've had a really good market at the end of 2019, even into early 2020, ideally what you want to do is that's when you want to sell off your positions. You want to sell off your positions when sometimes it might seem irrational, where the market is going straight upward. You want to try and pick up on that growth, but yet even taking some, not selling off a stock completely, but simply paring back on it and selling some shares and then taking that over into cash. That way you have cash there for withdrawals if you need the money, or for buying in during these market dips, because many people, when they're getting too greedy, like in 2019 when the market's going up, they don't have any cash. They have everything all in. And then when we have this correction where the market goes down 10 to 15%, that's a perfect time to use cash and buy in. And if people aren't taking cash and selling off stocks at a high point, then they don't have that cash to go and buy in during these market dips. And the other thing too is if you are taking withdrawals, the last thing that you want to do is to be in retirement and be fully invested and have to sell shares at a low point in a declining market to try and free up cash for your monthly withdrawals. So you always want to have some cash, and as a pre-retiree and retiree, it's important to make sure that you accumulate that cash when the market's doing well, take gains off the table, sell off at a high point. And then having cash also allows you to buy in during these market dips. And those who don't have any cash aren't able to take advantage of buying these dips at a low point. So it's something where when it comes to pre-retirees and retirees, the main thing is being able to have cash within your portfolio. And how you get that is by taking gains off the table when the market's doing well.
Okay, the last thing we're going to talk about is maybe one of the triggering devices we are starting to see creating such significant volatility out there. And we believe, unfortunately, is going to be one of the new normals here going forward when it comes to the market. And that is there's a term called algorithm trading. And Tyler will explain what that is. But algorithm trading is creating a significant amount of this volatility. And notice it's called algorithm trading, not algorithm investing. Okay, and when people are trading in this fashion, it's typically rash, it's typically severe and significant. So we're going to talk a little bit about that. Tyler, let's fill in the listeners about what the trading really is.
Yeah, Dean. So this has come up a lot more recently, algorithm trading, and what that's done is that's really added to a lot of the stock market volatility in both ways, up market and a down market. The volatility is really exaggerated by this algorithm trading. And what it is that once certain technical levels or technical indicators are reached in the stock market, so there's something called a 200-day moving average, or if the market hits if certain stocks hit a new 52-week high, or if there's something in particular trending on social media. So it's basically computers, and when there's certain triggering mechanisms like certain levels, then these computers that are often run by large hedge funds, they start buying and selling indiscriminately. So they're not paying attention to any different economic indicators, which historically is what the market trades on, but instead they're paying attention to, again, different types of technical levels, different things trending on social media, things that have nothing to do with economic numbers or data. And many of them are programmed to trigger based on the same technical levels, which leads to tons of the recent volatility that we've been seeing in the stock market. And these short-term movements are heavily influenced by the computerized trading. But the long term tends to reflect broader based economic trends. So what we see here are a lot of the short term volatility is actually caused by different computers that are run by hedge funds, and that allows all of them at the same time. Once there's these certain triggering of events, or if, for example, if Bernie Sanders is trending on Twitter a certain amount of times, then all of them will either sell off a certain amount or buy in a certain amount, leading to the market going up or down more so than it otherwise would. So really, that's called algorithm trading, where it's based on certain levels. It's not based on different economic trends, and that's something that can influence the market, and that's something that we've really seen over the last couple weeks with all the volatility, is all the algorithm trading. However, one thing to take away from this, though, is as an investor, it's the last thing that you want to ever be involved in. You want to focus on long-term economic trends and not the short-term trading that computers and algorithm traders bring to the markets, because over the long term, economic trends are what dictates the flow of the market, not the short-term algorithm trading. So keep that in mind. Just something that we want listeners to be aware of, that oftentimes when you see the short-term volatility, it's actually by algorithm trading, but we want you to pay attention to long-term economic trends.
Right, and there are some very good traders out there and very good companies that do algorithm trading, but they do it year in and year out. As Tyler said, when we see hedge funds selling off based on algorithm trading, that creates very significant volatility. And also remember here too, and this isn't across the board, but as a rule of thumb over the last couple of years, hedge funds as a whole have typically underperformed the market. So again, we look at things and take economic conditions into play. We look at a rational approach, and also focus on your portfolio. Don't focus on the market. Typically, your portfolio is going to respond differently than the market. If it's diversified, it is going to take some of that negative bounce out of there. However, on the flip side, you're not going to get 100% of the market gain. So remember, you can't control the markets, but you can control your game plan and your readiness when markets are showing this volatility.
Yeah, good point there, Dean. The last thing that I want to say before we close out the show is just, again, a reminder for our listeners during this market volatility. If you are a younger investor, again, take a long-term approach and continue to dollar cost average. You don't want to make any knee-jerk reactions or switch around your allocations in your 401k, but instead, by simply buying in every month or every paycheck, you're now buying shares at a low point, which is what you want to do over the long term. For those people who are in retirement or heading into retirement, it's important where you might want to make a few little tweaks. You might want to shift more defensively right now. But again, don't make a knee-jerk reaction either, and use this as a learning, as a teaching moment or a learning moment, where if you didn't have cash in the first place, you want to make sure that then you sell off positions at a high point, always have cash, so then you can actually use this as a buying opportunity as well to buy in low. But the main thing is, don't make a knee-jerk reaction. You want to be near-term aware but long-term focused.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.